Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Just here updating you on the market news and the economy. And I want to talk about, and I'm a little bit late on this video, but I wanted to do this for some time. I just haven't had the chance to do it. But I wanted to talk about the Jackson Hole event that happened in the end of August. And when Jerome Powell came out, and I kind of printed out what he talked about. It's remarks by Jerome Powell, the chair of the Federal Reserve. It says, reassessing constraints on the economy and policy, an economic policy symposium sponsored by the Federal Reserve Bank of Kansas City. So this was on August 26, 2022. So I want to talk about a couple of things, make a couple of highlights here, talk about what Jerome Powell said during that symposium, during that event, and a couple key themes and key ideas for you to keep an eye on and to monitor, especially from the language about raising rates and bringing down inflation. So his remarks were basically short, it was narrow, it was direct. There's also a video on it. You can Google it on YouTube, or I'll try to find the link and post the video below. And I think it was about 8-9 minutes long. I think typically it's much longer than that, but it was very short. It was very direct. He wanted to get a certain message crossed out to the markets. I mean, if you look at the equity markets, it's been rallying. I mean, it hasn't been rallying now, but previously it went up. If you look at NASDAQ, 24% since the bottom of June. And then since Friday on August 26th, NASDAQ had a big sell-off day. All equity markets, S&P 500, had sold off quite a bit as well. And ever since that day, markets been selling off after the remarks that Powell said. So I'm going to highlight and read a couple of things that he mentioned here. So one thing that came out to me that stood out on the first page, second paragraph, talked about restoring price stability. So he said restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. So he's reiterating basically the few things that other Fed members have been talking about, is that this price stability, this inflation that we're seeing, it's going to take some time. It's not going to happen overnight. And they're using their tools forcefully. So use the word forcefully, which I think is very key. I mean, it might be, these little words here and there that might be subtle, but they mean a lot. That saying that you want to bring, using the tools forcefully to bring demand and supply into a better balance, because they know they can't really control the supply side. A lot of the inflation comes from the supply side. When you look at the supply side of supply chain, and you look at commodity prices and whatnot, a lot of it has been disrupted by the supply side, which basically pushed up prices. So what can the central bank do is basically manage the demand side to try to create the equilibrium between supply and demand more at a reasonable level. So if they can manipulate the demand side and kind of forcefully use their tools to bring demand lower, and that would eventually or hopefully bring prices lower and keep the balance between supply and demand at a reasonable level, which would bring prices at a reasonable level as well. So that's the first line in that paragraph. Now, he also said reducing inflation is likely to require sustained period of below trend growth. So remember, we're talking about growth and demand here. We start off with demand, bringing demand down, forcefully bringing it down, and saying that to bring inflation down, this demand, this growth needs to be at a below level for some time. So below trend growth, below your typical growth rate, you need that to be below the trend for some time. And if you've got, this below trend growth for some time, you can bring the prices down, hopefully over time. Moreover, there will very likely be some softening of the labor market conditions. Now, if you've been looking at the data and the numbers coming out from the labor market um, information from the U.S., basically you've seen that wages have been moving up. Now, it has somewhat come off after the recent non-farm payrolls and average hourly earnings number, and we look at the ISM prices number. Now, that doesn't have to do with wages, but it can be. If you look at somewhat of the prices since last CPI report and the numbers we're getting now, it's showing some softening. Now, if you can manipulate and kind of soften the labor market, now think about it in this way. Prices have been elevated while the labor market and the unemployment rate has been at all-time lows, and the labor market has been very, very strong. So how do you bring prices down? What would be the reverse opposite effect of this? It would be to bring the labor market into more of a softening conditions, which means that increase the unemployment rate so that wages, which are known to be sticky inflation, they stick around for much more longer and have a prolonged effect. Wages should hopefully come off, and as the unemployment rate continues to move up. So hopefully, because there is an issue with getting and gathering employees, there are shortages of employees while there's demand, and you have employers pushing up the wages. Hopefully that this push up in wages because of the lack of employees will basically bring the wages down. And add on to that, since we're at a very low unemployment rate, we can start increasing the unemployment rate, and wages will maybe possibly balance out. That could be a possibility, right? I'm not saying that it's exactly going to play out like that, but definitely when the Fed comes out and says, like, there very likely be some softening in the labor market conditions, the effects of a softening labor market condition is obviously you're not going to see wages go up, so it doesn't feed into higher inflation, higher prices, more money in your pocket, more spending. If you're paying more to employees, guess what? You're going to increase the prices of your goods and services, and it all trickles into higher inflation. So let's bring that down, let's soften it, and that's what the Fed is going for. Now, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. Now, I think this is a very, very key line. The fact that the Fed came out and says that, sure, we might see higher inflation, interest rates, slower growth, softening labor market conditions, and these are the three things that we need to bring down inflation. Even though this will bring down inflation, I'm sorry, but yes, this is going to cause some pain to households and businesses. So the fact that we transitioned from a year ago to not even talking about raising rates, not even talking about recession or pain for anybody, to now, fast forward, raising the rates aggressively, doing things forcefully, bring down inflation, soften the labor market conditions, and also to not only to bring down the prices, but guess what? It's going to now bring some pain, which means hints, aka recession, aka higher unemployment rates, aka job losses. So yes, it's going to bring some pain to households and businesses, because higher yields, higher interest rates, more payments, while there's elevated inflation, and if you are losing jobs or letting go workers, it's all going to bring in some pain. So the fact that he mentioned that, to me, what it tells me is this recession story, the fact that we were talking about, the Fed was talking about soft landing, the Fed was talking about, not even getting into a recession, without even saying the words of a recession. The Fed's not going to come out also. The Fed's not going to come out and say, hey, we're going to take the markets and bring it into a recession. They never want to do that also. But from reading these words, it looks like that they want to move to that direction, slower growth, softening labor market conditions, higher unemployment rate, which hints towards recession, to bring inflation down. Now, if you look at the CPI and you look at past inflation over the past 20, 30, 40, 50 years, look at how a CPI has behaved every time we have gotten into a recession, right? Every time we've gone into a recession, CPI just drops like a rock. And we get CPI way below that 2% mark. And CPI inflation in the US is around 8.5%. So if you get CPI inflation around 8.5%, my question is, how do you bring down inflation from 8.5% all the way to your mandate of 2% or below, and not only below 2% on your target, but leave it there at 2% and leave it there for months, couple of months, so that you also bring the average down? Because remember, the Federal Reserve 2 years ago changed the way they were calculating inflation, and that's why they prolonged higher inflation for some time previously 2 years ago with the concept of AIT, average inflation target. Now with AIT, average inflation target, the idea was prolong and let inflation overshoot couple of months, so that the average number, when you're adding all the inflation number together, the average moves up. That means you need higher inflation month over month to bring the average up, because it takes time. You need a couple of data series, couple of data points higher for some time, elevated for some time, to bring the average higher, right? So same thing, if we do the reverse, bring the average lower, means that bring inflation down below 2%, maybe even to negative territory. And for that inflation month over month, if it's below 2% or negative territory, then guess what? You're bringing the average down lower and you're hitting your target. So, this basically tells you that, okay, when you look at that history, that back in 2008, back in 2000, with those financial crash, the financial crisis that we had in 2008, and the recession that we had there, the recession in 2000, recession in 1980s, if you looked at all of those, the recession, all of them, if you look at CPI and inflation, all of them have led to lower inflation rate below the 2% target, which is the Federal Reserve's mandate, their target. One of their mandates is to create price stability, to bring inflation lower, right? So, and their target that they go for is 2%. So to bring it down, again, just look at the history of CPI, look at the history of inflation. Every time we've had the chart go up and then boom, a big drop lower, it was after we were in this massive, severe recession. So, putting it all together with the comments that the Fed is saying, putting it together with the data out there, the fact that when he comes out and says it's going to bring some pain to households and businesses, and these are the unfortunate cost of reducing inflation. This is just the cost. You're going to have to bite the bullet. You're going to have to bite your t-shirt and just, it is what it is. It's just going to bring some pain. So, to bring inflation lower, to me, when I read this, it hints towards maybe this recession that people are talking about, the fact that we are in a technical recession, but the US government denied it. Will we see the true recession and the numbers reflected? Right now, non-farm payrolls, the ISM data, the growth data that's coming out, it's coming out as pretty strong. Like the economy is doing fine. So sure, great. I mean, right now it's doing fine, but 6 months down the road, when we look at January 2023 and onwards, the effects of higher rates, it has a lagging effect on data. So we may see the effects of that maybe next year. And then maybe we might see ISM or the non-farm payrolls or the other data, growth data numbers come in very weak and contractionary, and we might see that unemployment rate start to kick up higher, maybe to 4% or even higher, or 5% and onwards. So, and that will be your sign that yes, now looks like the recession is here, if it's not already here, and looks like it's kicking in now a little bit harder now. So, also mentions here the labor market is particularly strong, but it is clearly out of balance with demand for workers substantially exceeding the supply of available workers. So just like I said, a lot of work, there's a demand for workers, but not enough supply of workers out there. So that needs to be adjusted, which is feeding into the higher wages, higher inflation. He talks about while the lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that the inflation is moving down. So he said the last July report that we got with a softer inflation reading, it doesn't mean we're done and we're going to start easing and we're going to start cutting rates or slowing down the rate hike cycle or the QT process, right? And this is what a lot of the market participants were thinking. And if you look at the rally in June, you see the rally in June, markets were moving up higher and higher and higher. And then after the CPI report moved up even higher in anticipation that the Fed's going to slow down its rate hikes because prices are coming down. But Fed here denied that. And if you look at 2021, if you look at last year's inflation metrics around the same months, summer months, it also dipped down a bit, and then eventually as September, October, November came, it peaked again. So they're not calling it win all of a sudden. They definitely want to see more readings, and I think even the second reading that we're going to get may not be enough. There was a Fed member that came out and said that we want to see maybe 3 or 4 readings before seeing or feeling some confidence. And it might be that we might want to wait till October, till November and see, okay, is inflation really coming down? And you want to watch crude oil. You want to watch energy prices. If you look at crude oil, it has sold off a bit. And if you look at it technically, it has bounced off its previous resistance level and it's upticked, which means that that previous resistance level, which is now support, it's now holding ground there. And if it continues to move up and make a new high, definitely that's going to feed into higher inflation, higher prices. It's going to affect the decisions down the road for the Fed to continue at its pace and maybe even be more aggressive to bring the inflation lower. Now, when you in another paragraph, the Fed came out and said, talk more about the 75 basis point rate hike. I talked about the interest rates. So he said July's increase in the target range was the second 75 basis point increase in as many meetings. And I said then that another unusually large increase could be appropriate at our next meeting. Now, it doesn't say exactly what that unusually large increase may be. So it just hints towards either a 50 or 75. Now, what we've heard from other Fed members after this is that some of them are leaning towards that 75 basis point rate hike. If you look at the CME Fed Watch tool, there's a 60% probability that we'll get a 75 basis point rate hike in the end of this month in September. Now, obviously that can change. That probability can change in the matter of next week, especially if you get a weak CPI print next week. So we'll see. We'll continue to watch that. And then he talks about in another paragraph about Paul Volcker style rate hikes. So he said, our monetary policy deliberations and decisions built on what we have learned about inflation dynamics, both from high and volatile inflation of 1970s and 1980s, and from the low and stable inflation of the past quarter century. In particular, we are drawing on these important lessons. Now, Fed has mentioned Paul Volcker, has appreciated him a couple of times in his previous meeting and speeches. So the fact that he brings this back up again and he says that they are drawing on the three important lessons. They're drawing up what they've learned back in 1970s and 80s. And more specifically, what he's talking about is the fact that they raised rates back in the 70s, 80s, cut them, and then raised it again because they got to bring inflation down lower. Now, what he's going for is learning from that and saying that maybe leaning towards, and I think he mentions it here or he mentions it somewhere else, that that they don't want to follow, and actually I think I have it here, they don't want to follow that process of raising rates, cutting, and then raising it again. They want to just go all with one shot. So instead of doing what Paul Volcker did, raising rates, cutting it, creating some easing, and then ramp it up again to create some tightening to bring the inflation lower, they are more leaning towards keeping rates higher for a longer period of time and continuing to maybe elevate it, which means that the chances of them cutting rates or easing is very low. So here, I highlighted here, it says, during the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of households and businesses. The more inflation rose, the more people came to expect it will remain high. They built that belief into wage and pricing decisions. As former chairman Paul Volcker put it, at the height of the Great Inflation in 1979, inflation feeds in part of itself. So part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectation about its future path is based on concept of rational inattention. So he was looking at this and saying that, the fact that people are looking at inflation, as soon as it gets engraved, it gets entrenched in people's minds, the inflation rate will continue to be elevated. And when it comes to decision making, like wages and pricing decisions, that will feed into the high inflation. So they don't want to keep it higher for, they don't want inflation to remain higher, which is why they could see that leaving rates at higher level could be the best possible outcome to bringing inflation lower. So he also mentions here, the longer the current bout of high inflation continues, the greater chance the expectations of higher inflation will become entrenched. We must keep at it until the job is done. And when he means by it, he means interest rates. So history shows that employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. A lengthy period of restrictive monetary policy was ultimately needed to stem the high inflation and start process of getting inflation down to low and stable levels. Our aim is to avoid that outcome by acting with resolve now. So you see that? So he talked about Paul Volcker and said, okay, he went out to try to bring inflation down. He went up, cut the rates, increased it again. And these are the lessons that we learned. Inflation became entrenched. It was elevated for some time. And after reviewing this and after learning from this, a lengthy period of very restrictive monetary policy was ultimately needed to bring high inflation down. So long time of higher restrictive policy, higher rates, elevated rates to bring inflation down will probably do the job. And he said, our aim is to avoid what Paul Volcker did to keep the inflation, well, not what he did, but the idea of cutting rates and then raising it higher, our aim is to not take time like how Paul Volcker did, but to act now. And act now means higher rates now, elevated now, faster now. So that keep the rates elevated, push on that higher rate, see how far we can go, and to bring inflation down, which again leads to my thought again, keep inflation elevated for some time, keep pushing on the higher rates. If inflation is not coming down, ramp it up, recession, right? So it may signal maybe recession, that if you keep going at the current pace, people are going to feel the pain. Not just some people, a lot of people. And then to finalize the last paragraph, which I think is very, very, very crucial and important, he says, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it becomes better in alignment with supply, and keep inflation expectations anchored. We will keep at it until we are confident the job is done. So the fact he used the word forceful, the fact he used rapid steps, he said we are taking forceful and rapid steps to moderate demand. You got to bring the growth down, got to bring the demand down. And he said we will keep at it until we are confident the job is done. So the whole idea of the rally since last CPI report, which caused markets to go up even more, it completely reversed that whole rally, because after this whole meeting and after this report that Powell put out in this commentary. So I think it speaks a lot that the fact that they want to bring forceful rapid steps, they want to moderate demand, they want to raise rates, and they're not going to be done until the job is done. Remember, they have a mandate. The Federal Reserve, the central bank, the U.S. Federal Reserve has a mandate, two mandates. They've got a dual mandate to make sure jobs are fine and doing well, which they are. Unemployment rates are at very low levels. And second mandate is price stability, and they're not succeeding on that second one. So they're not going to finish. We will keep at it until we are confident the job is done. So they're not going to finish until the job is done. So that's why, it makes sense for that sell-off to happen and may continue as markets start to price in or reprice that the Fed is going to act more aggressive than expected. Now, things can change definitely if things start breaking in the recession, in the economy, and we do get an ugly recession, then sure, markets will start to price in right away some rate cuts. Very fast rate cuts to come, because markets will start pricing in that the Federal Reserve is going to cave in and they're not going to keep rates elevated for some time, especially if recession is ugly. And if it's very ugly and it's harming the economy for some time, definitely the Fed's going to do something and intervene, and that's where you might hear the Fed put again to help the economy and push it back up. We'll see. I don't know. That's what the markets are pricing in. We'll see if the Fed caves in, if that happens. And what if inflation doesn't come off? Now, history would suggest when you get an ugly recession, inflation will come off. Now, if we don't get an ugly recession, we get mild or not so bad, and inflation's still elevated, they're still not hitting their 2% target, which means that they may have to do more. And what does more look like? Right? In September this month, they're increasing their balance sheet runoff that they're doing. The retiring of the bonds, which puts QT into much more of a higher effect in terms of the balance sheet. Now, what about the rates, interest rates? Could they push it to more than 4% this year? Could they push it to 5% by next year or higher? And if they do that, maybe that's what it might take to bring inflation lower. So let me know what you guys think. Leave a comment below and like and subscribe, please, if you like this channel, and would be very curious to hear your thoughts. All right, everyone, good luck, and I'll see you around. Bye.